Good afternoon and welcome to Innate's first practice development webinar of 2022. I can hardly believe that it's already March. I'm really excited about today's session. My name is Mickey. I'm the CEO of Innate. And you know, as the CEO, I'm always looking forward, always considering where and how our industry, the financial advisory industry, is changing and evolving. And we do this as Innate as part of our commitment to being advisors, partners, and really bringing them interesting, relevant, and knowledgeable topics to speak about. I know how busy you are as advisors are on a daily basis, doing what you do best, which is advising clients. And that sometimes, you know, is that it's very hard to sort of lift your head up and ponder about what the future is about, what sort of information you need to familiarize yourself with, and what's really available out there. And so what we do in these Innate Connect sessions is really bring that to you. It's our commitment to help you sift through some of this information and bring global and local insights curated to your desktop. And today is just one of those key opportunities where we're going to do that. Now, we know that the pace of change has never been this fast before in our industry, nor is it ever going to be this slow again. What are the drivers of this change? Where is this change taking us, and how is it going to affect your practice today and in the coming years? What are the changes and how are these changes going to impact your bottom line? Where are they coming from, and how can you prepare your practice to embrace them, not only to survive, but to also thrive in the coming years? Joining me today as we filter through trends versus fads and understand these real drivers of change are a couple of really key knowledgeable guests on the webinar with me. From the US, Capgemini, Tej, Tej and his team have produced a really insightful and well-researched paper of global wealth management trends. Tej is the senior wealth management industry leader and global head of ESG at Solutions at Capgemini. Tej, you're welcome to say hello quickly. Cool, thanks, man, Tej. And then also in the US, we've got Lou. Lou has a research paper called Wealth and Asset Management 4.0. He's based this survey off interviews with over 2,000 investors and 500 wealth and asset management firms. Lou's the CEO of ThoughtLab and has more than 35 years of research through publishing work. Lou has helped top organizations build their businesses and engage corporate and government decisions. Lou, thanks for joining us too.
Great to be here, Mickey.
Thank you so much. And then obviously local is lekker, as they say, in Cape Town. Bringing some real insight into the changing client behavior and needs is Gizelle, who's not only a professor, but also a behavioral economist. Giselle's insights really share with us where South African clients' mindsets are and how they're feeling about financial advice. And these are very important for us clearly to understand as financial advisors. Hi, Gizelle.
Hi, Mickey. Thanks for having me. Welcome, everybody.
Good, good. And then last but not least, and keeping it real in terms of what this all means in an advisor's practice, we've got Louis, a local financial advisor and founder of WealthUp, looking very snazzy there with all his tech here. Hi, Louis.
Hi, Mickey. Thanks for having me.
Pleasure, pleasure. Good. So as I said, guys, we've got some really interesting content and debate. The next hour or so, hopefully we're going to bring you some lively debate and discussion on three major trends we are seeing. And we hope that you'll come away with some real food for thought on how to prepare your business and take advantage and lead the way, really, in these trends. Later on in the webinar, we'll be opening up to Q&A. So you can ask those really tough questions to this panel. And please do engage the panel. The guys are really insightful. And remember, there's no such thing as a silly question. So leverage their collective insights, listen to what they have to say, and really get those questions out there and let's learn from the guys. So I'll probably get the conversation going a little bit, if that's okay, to the rest of the panelists. Really, what I wanted to do, and the first sort of topic that I wanted to speak about is really this move from product to holistic advice, if I can call it that. Now, we've seen the continued trend of financial advisors focusing more on advice and moving away from selling products and picking funds. You know, we all know that gone are the days of fund picking, and in are the lifetime goals planning and wealth management for our clients and their needs. In South Africa, we've seen a strong focus by our financial advisors, specifically on investments or wealth management, you could call it, with a large proportion of these financial advisors now citing roughly 90% of their income coming from wealth management and investment advice. You know, I think with the continued evolution of technology, technology really automating and bringing a low-cost, high efficiency into the game, this move from advice and the move away from product, I believe, is really here to stay. Now, Lou, if I could ask you maybe a question, you know, in your paper, you talk a little bit about the democratization of advice. Can you share with us how you see this unfolding and unpack globally what you've seen and what do you mean by this actually?
Sure. Well, Mickey, first of all, let me just say that we studied 2,300 investors worldwide across all wealth levels and generations. And we also surveyed 500 financial institutions in the wealth and asset management industry, representing 1/3 of the world's capitalization. And what we found is that holistic advice is moving front and center to the client relationship. And I think the pandemic had a lot to do with this, because the pandemic actually made investors more concerned about risk and diversification. It made them more concerned about their holistic financial situation and that of their families and their legacies as they faced their own mortality, actually. And so at the same time, many retailers joined the market during the pandemic. I work with Charles Schwab here in America. They talked about 7 million new retail investors, and people had more time on their hand to think about finance and to think about life changes and moments that matter. And so what happened is that we found that that holistic advice became even more important. And when I say holistic advice, I'm talking about personal financial budgeting, advice on non-investment services like insurance, tax planning, day-to-day financial management. All of that, according to our study, became more important to investors. And what we found that was really remarkable is that it wasn't just with the high net worth and the ultra high net worth. It was happening even at lower levels of income and even among millennials. And so what we're finding is that, you know, personal finance, in fact, the mass market was just as involved in that kind of advice as was the ultra high net worth individual. And so why is this happening? Partly it's because there's an intersection, a blurring between wealth levels and what they actually want. People want lower income. People want some of the same kind of services and products that the super rich have. But the other big thing is what you said, Mickey, is digital. Digital is the great leveler, and what it's doing is it's allowing, it's helping financial institutions provide advice in new automated ways. And even in one of the companies that we interviewed was InvestTech, which I'm sure you know very well, and they have pilots to automate holistic advisory solutions, just as Schwab does here in the States. So it's really what I consider to be a global phenomenon.
Good. And Tej, maybe a question to you, you know, coming in on that same vein. What are you seeing in the holistic advice space driving this from an operational and revenue perspective? You know, Lou's talking about a broader client base wanting to access advice, more wanting what some of the wealthier clients have. What are you seeing in that space, and how are guys and businesses coping with that? And how do they meet those operational and revenue, I suppose, requirements of their organizations?
Yeah, that's an interesting point. And, you know, I think one thing before we get into, you know, how to operationalize is thinking about, you know, why is there a demand? And if you go back and look at, you know, the trend, it's all about longevity, and longevity is multifold. One, with respect to, your customer itself are living longer. That means now their needs are changing, evolving over a period of time. What needs are in 20s and 30s would change into 40s and 50s, and what needs going to be in 50s and beyond 50s, 60s, and 80s are going to be completely different. So that means if you have a traditional way of thinking, providing advice, just the financial advice, that may not cut it because it would evolve over a period of time. And it needs to be lifelong journey. And this is where, a lot of our customers, when we talk to them, we talk about creating a business model, an operating model, which is engagement for life, rather than thinking about, engaging with respect to their financial and investment management. It's about engagement for life. And to operationalize, you need to think about their finances. You need to think about their relationships. You need to think about their lifestyle. You need to think about their philosophy and philanthropic needs and bring all of that together. And when you do that, some of the leaders, what we have seen, and we actually partnered with them, is now getting into a next level of evolution where a lot of these services around lifestyle, a traditional bank or a wealth manager may not be able to provide. But what they could do is they could form partnership alliances with other lifestyle providers, and then create some sort of a concierge service into areas where they cannot extend themselves, or they can form partnership with some of the other extended financial services providers. So let's say if it's a wealth manager but they are not into the insurance business, then they could actually partner in providing some of the protection services, some of the healthcare services, some of the lifestyle services. And this is where I think, having a broader perspective about what you're offering and how you're engaging with your customer, and if that is how wealth manager looks at it, it would go a long term and becomes, a pretty much engagement for life. And this is where I think the prime focus is.
Sure, Tej, that sounds quite intimidating if I was a financial advisor. I mean, Louis, if I can bring you in here, being a partner for life, what are you seeing from a South African perspective in terms of this trend? How do you see this play out, as a financial advisor, and what impacts does this really have on a financial advisor's practice? What does it mean for him?
And this is again,
Thank you, Mickey.
yeah, sorry, go ahead.
Mickey, I smiled when Tej said that because it really resonated with me and the way we engage with our clients. And I think what happened is that, this trend probably started 50 years ago when the CFP board in America started the certified financial planner, because there was a need for financial advisors and wealth managers to demonstrate more value. And the dilemma that clients have is that it's extremely difficult to know if someone's really adding value. There's an interesting study in the 1990s by Sharma and Patterson where they looked at how do clients actually determine if financial advisors are adding value. And the proxy that they used was the way they communicated. And so when you think of the way you add value, it's probably through the technical piece. I think what everyone is assuming, you're adding value in wealth management, you're adding value in other areas of someone's life, through the lifetime value. But equally important is this functional value, how you communicate, how you show up when someone might have lost their spouse. And I think we're seeing this shift into training advisors to become future-proof through things like life planning that George Kinder is doing, the Financial Transitionist Institute. I would argue that it's post-holistic financial advice and that it's becoming someone's thinking partner. And that's definitely how we approach our business and start having conversations of how do we add value 10 or 20 years from now? And what are the skills we need to be working on today to ensure that we're still relevant?
Absolutely, absolutely. Sorry, Tej, coming back to you, I think you wanted to answer a point there too quickly.
Yeah, thanks. But yeah, the point I was trying to make into what, you talked about South Africa, and in general, this is relevant globally for everyone. It's about knowing your customer, their needs before they know. So it's like know before they know. If you know as an advisor that what your customer would want, that is going to take you to the next level down, right? And I think the drive, going back to the sustainability there is an interesting book I was reading, The 100-Year Life, and it's from Linda Gretton. But the book talks about, living and working in an age of longevity. So that means, how your needs and how your life and how your, lifestyle would evolve over a period of time. So this is, I think, knowing life events, knowing work events, and bringing that awareness is quite important. I think that was the point I was trying to make. Thanks.
Absolutely. So Gizelle, it sounds like we need a crystal ball so that we can understand what clients want before they know what they want. So from a client perspective, what do you think is driving this behavior that we're seeing in terms of clients and what their demands are? And this move, I suppose, from giving them products to really being a coach, what it sounds like, if you're going to be engaging with these people through their lifetime, if you're going to be a lifetime partner, I suppose you're really going to sit alongside them and coach them. And so what are the client and consumer behaviors that you see driving this sort of change?
Yeah, I've really been enjoying listening to everybody else's viewpoints on this. Let me answer your question. I don't have a crystal ball for you though. But this whole move from sort of product to coach, if you think about product, all the information on product is already out there. We can easily access it. It's for free. If I want to draw up a will, I can download a template and I can draw up a will. If I want to invest in cryptocurrency, I can read a blog and figure out how to do it. I'm not necessarily saying that information is correct, but there's enough information out there that can at least make me feel like I can do it on my own. Okay. Now, what can't the internet do for us, right? The internet can't tell us how that particular investment decision we're making is going to influence the rest of our financial portfolio, particularly all the short-term debt we're carrying and the lack of an emergency fund that we have. And that's the gap. That's the gap where the financial advisor can come in and coach the client, right? Not try and sell product, but rather coach and guide the client as they go through their product making decisions, right? Providing a perspective that goes beyond today, but goes into the rest of their life, into the future. That's that lifelong partnership. The advisor can see that far ahead. And it's when the advisor can start providing that guidance and coaching from that level. That's when the client starts to see that value, which Louis says is so difficult to define, but that's when they start to see value. And that's when they become willing to pay for that kind of value.
Good. So, I think that's a fantastic segue, and thanks, Gizelle, into sort of the next trend, which is these new client expectation trends. I think what clients used to expect from financial advisors in the past and from the industry in the past is fundamentally changing, going forward. And so, it would be very interesting for me to try and understand, and I'm sure for the audience too, what some of those new client expectations are that we could expect going forward. You just mentioned about getting information off the internet, misinformation, but as you say, that can't validate, that can't help, that can't show you how that impacts a larger plan. What would you say, and specifically from, I think, a South African perspective, are some of these new client expectations that we're seeing coming to the fore? Yes, please.
Yeah, I think when we think about sort of new client experience, you're always going to ask yourself sort of, who is the new client, right? Who's the new client that we're seeing? And we've got the rise of the millennials coming through with the Gen Zs hot on their heels. And those generations are significantly different to the baby boomers that you've currently been advising with their retirement decisions. And one of the sort of key differences between those generations is that these millennials, they're not as loyal when it comes to service providers, and they're not as willing to pay for something called advice, right? They're not going to trust you blindly. They're going to look at all the options before they make a decision, and they're not going to be satisfied with those sort of traditional asset classes. They're going to be interested in that latest NFT that someone's talking about. I must be careful about my own viewpoints coming through on that. But nevertheless, if they're interested in those kind of instruments, you need to make them available for them and put safeguards in place to ensure that they sort of manage the volatility and risk that comes with it. They care about climate change. They're interested in ESG investing. They want immediate gratification. They want to make autonomous decisions, but at the same time, they also want a bit of human interaction when they need it. So you need to be asking yourself, how is you as an advisor in a practice, are you setting things up that you can actually meet those needs of that new client that really is going to be the one that's sort of metaphorically knocking on your door?
Sure. It sounds to me like, you say that the one, it sounds to me like hyper-personalization is the talk of the day now. And, if you're not hyper-personalizing things, how are you going to cope? Tej, I mean, you've spoken a little bit previously when we were chatting about hyper-personalization. Sort of your thoughts on practice and hyper-personalization and in a financial advisor's practice?
Yeah, that's an interesting point, what you bring in, am I right? And if you think about hyper-personalization, what comes to mind is why it's relevant, why is it necessary? And if you step back and look at all of us surrounded, what are we surrounded with? In maybe one simple way to describe it's called FANG conundrum. We are all surrounded, and when I say we, means all of us, advisors, investors, us, everyone is surrounded with this whole FANG companies, and what they inherently make us believe that every time I'm going to have open an app or go to a portal, that application or tool would know what I'm looking for before even I finish my thought. And take an example of Google. How many times you have started typing to search something and you actually type the whole thing? Halfway into what you're typing, Google would already know, or they would actually start prompting you that, okay, are you looking for this, this, or this? And all you have to do is pick what you were looking for rather than you completing your question itself. Apply the same thing to Amazon. Most of the time, when you're going and trying to shop at Amazon, they not only tell you what you're looking for, but they're offering you three other things might be relevant and maybe on your mind. One out of those three are already on your mind that you might be looking for. So they are proactively nudging you some of the products or nudging you things which you might be interested in buying. Extend that to Netflix. So I started with search, then I took into shopping, and now I'm getting into entertainment or viewing. A lot of times, Netflix, while you're watching things based on your behavior, it understands your style, your way, likes and dislikes, and it knows exactly if you're opening at to watch something at 9 p.m. versus 5 p.m. versus Saturday or Friday. Things might change, and actually it's making recommendations based on your behavior, based on your preferences. And that is what I call it, that whole FANG conundrum. That means now all of the users they are pretty familiar with that, and now they have inherited expectation that if I go and open up an app of my wealth management firm or go and talk to my advisor, he or she would know exactly what I'm looking for. So I do not have to describe everything. That means there is an inherited expectation that I will be provided with very personalized services, communications, interactions, and even products are being suggested to me would be aligned to what my needs are. And this is what I call hyper personalization and the need for that. And when you talked about new client and demands, I would also look at it that two other drivers are actually driving them. So first one is itself this whole demographic shift. If you think about it, and if you look at some of the numbers, just in the US, and I can throw some numbers around US, starting in next 18 months, there will be 12,000 retirees every day. That means those 12,000 people every day will be retiring just in the US. And if you extrapolate that number globally, that's massive number. So all of those retirees, their needs are changing, but at the same time, some of them are also transferring their wealth to the next generation. And that brings the second driver. What we are going to observe in next 10 years and 15 years, it's going to be one of the greatest wealth transfer we have witnessed in human history. We're talking about over $60 trillion of assets going to change hands. And when they are going to change hands, this is moving to the next generation. This is where you're talking about, youth taking over. Their ways of workings are different. And what Gizelle was describing, if you go back, millennials are not interacting the way traditionally, investors were interacting. So their preferences, their needs, their behaviors, and their philosophy are completely different. And that is what I call it, am I right? New client demands is important, understanding that.
Absolutely. I mean, that wealth transfer, Lou, maybe a question for you. You know, this wealth transfer is coming along. Tej has spoken about hyper-personalization. Gizelle mentioned NFTs or non-fungible tokens. You know, what are the behaviors influencing investment choice, and what sort of investment choices are we going to need to see in the future? Are we going to need to understand in the future to be able to cope and meet these demands from investors?
Well, I think the future, our study looked at the future, and it actually, to me, is showing a different picture than we're hearing from Gizelle and Tej, okay? A little bit different. And I'm going to tell you how, okay? And I don't want to be too contrarian here, but it's early in the morning here in America. But let me just say a few things. First of all, I think we're in a period of hyper-personalization. I think we can all agree. But I think hyper-personalization is really not just about technology and Netflix and what they can do. And it's really not about the old ways of thinking about segmentation. Because I think even the old lenses that we were using are no longer adequate in a period of hyper-personalization. That is to say, our study found that some of the demarcations that we believed for up until now, over the years, that I learned when I was at The Economist and I was in finance, which is that high net worth individuals want this, and low net worth and mass affluent want that, and millennials think this way, and older people think that way. That's all being turned on its head as we enter 2022 and emerge from the pandemic. The pandemic was a watershed moment for a lot of this old thinking, and is what I think it is. So what I'm saying is that this idea that millennials understand digital and older people do not, they don't get it. They want it the old-fashioned way. Not true anymore. Not true at all. Baby boomers also had to use digital during the pandemic, and high net worth individuals can afford the best smartphones. So it is really not the case anymore. And by the way, super rich people like to look at their phone and see how their wealth is doing. So it is completely changing. I'm not saying anybody's wrong. I'm just saying I think we have to be looking at a more fundamental sea change. And when we think about people, the other thing is that this idea that that younger investors care more about sustainability. That's not true either. Baby boomers actually are planning, according to our study, to invest more in ESG funds and green bonds than baby boomers than younger investors and millennials. So, some millennials still want to make money, and they're in a phase of their life that they want to invest in even higher risk ideas like their cryptocurrencies, okay? And they're willing to take the risk. So it's very different than what we're thinking. There's even, Gizelle, a point of view that I'm sure you will agree with. There's a point of view that some people thought women know less about investing than men. That's not true either. Our study found that women actually had more financial intelligence than the men in our study, by the way. And I think that the idea that the rich don't care about SDG, not true either. That's they've been doing philanthropy all their lives, and they really do care about ESG investment advice. So what I'm trying to say is that we're in uncharted territory. The world, and I mean, I don't even want to think about the geopolitical situation we're in and how that's affecting markets, but we're in uncharted territory, and the world is changing. And as a result, you can't even look at stereotypes by age and wealth levels. You got to look at it at the person, not the demographic. And that to me is hyper-personalization. It's really understanding that individual, not making assumptions, certainly using technology, as Tej said, certainly using it, but also using emotional intelligence and all the other tools that we have to really understand and move from a product approach, which we know is not going to work that well, to a really hyper customer centric approach. So that's what I'm seeing, Mickey.
Yeah, look, fantastic view. Let's come straight to what we say in South Africa, where the taki eats the tar. I mean, Louis, you're a financial advisor. You're faced with this stuff on a daily basis. What are you seeing happen? How are you coping with it from a client expectation perspective? Sort of your thoughts on the two topics from what Lou has just said and what Tej has just said. We love to hear what straight from the financial advisor, what you think.
Yeah, I think it's really interesting listening about global trends and thinking about ways people interact with products. And Accenture last year put out a survey where 96% of the respondents said they would immediately buy financial products from Amazon, Apple, or Google. And to me, that can be scary as a financial planner, thinking that you might have a massive competition, just around the corner. From Lou's comments, I think what we're seeing is that this focus on the internal locus of control. Now, what is that? Well, that's really the things that someone actually have control over. We don't have control over what happens in the news, what happens, in war-torn countries. What we do have is the control over our emotions and our actions. And to Giselle's point around creating this coaching way of being, and the starting point of the coaching way of being is saying that the client has almost all of the answers, but they just need a little bit of guidance to get to a solution that's suitable for them. And for me, that's at the heart of hyper-personalization, is helping someone to find a solution that's suitable for them. Now, that means that there has to be a fiduciary responsibility on the advisor. There has to mean that you act in your client's best interest first, even though it might not be a good fit. And that means that you can build a sustainable business, irrespective of the trends and people wanting to invest. And last week I heard that the biggest group on TikTok that's been growing is the 35 to 55 age group, and it has been for the last 2 years. So we're creating a new way of expectation of how we want to engage with the brands, but the things that are staying the same are the things that we have control over and the conversations. And so my guess would be that as advisors, we need to spend time being able to ask better quality questions. Just like Google spends time on fixing the algorithm and YouTube has better stabs at what you're trying to find, the financial advisor has to ask better quality questions to get to what's most important for that client.
Lou, it sounds to me like you're going to run out of time in the day. If that's what you need to do, maybe before I go into the next topic, I can just ask, some of the audience, please, guys, if you've got any questions for any of the panelists, please do put them through. I'm happy to ask the questions. And so, I think that sort of brings me to the next big trend. If I think a little bit about it, we've seen now this move from product to advice. We've spoken a little bit about the changing client demand and really, simply the global digitization that's been forced upon us and this industry as a result of the pandemic. And personally, I don't think we'll ever go back to the way we used to operate. So that must mean that we need to turn to technology, and discuss a little bit of technology in the advisor practice and in this and in our industry. So, technology, we know we often use technology to drive efficiencies, to save time so that you can get more of those hours in the day, Louis. And this has got to have an impact on the value of advice and how we run advice. Maybe a question, Tej, for you. Sort of what areas are you seeing the biggest change in terms of digitization, and sort of what technologies are being used to drive that?
Yeah, interesting point. And again, I'll go back to what, previous, just conversation where we talked about is, the pandemic had a massive impact on digitization. And, what if you would have asked 5 years back to a baby boomer saying that, would you be open to talk to your advisor, over a phone or email or a chat if you cannot see him or her? They would have responded saying that, then I would change my advisor if he cannot even come and see me or meet with me, right? But now if you ask in last 2 years, we were interviewing a month and a half back last winter, we were interviewing advisors. And one of the things we found interestingly is 9 out of 10, they've already transitioned into majority, 75%. So 3 out of 4 of their meetings, which they do with clients, are video calls. They've also started doing a bite-size chatting on a regular basis with their customers. So now what is happening is, irrespective of age spectrum across everywhere, they've started having video calls on a regular basis rather than predefined frequency of every quarter meeting in person. They've started doing these bite-size small, and this goes back to, again, whole TikTok thing, where they're talking about, rather than a long message, they're sending us bite-sized messages based on what's happening in the market, what's happening with their portfolio, what's happening with their life events. They're actually having constant communication, and that is also becoming, changing, shifting a lot. So I think technology can add tremendous value. And now the beauty with the pandemic is, the adoption of digitization was a challenge in wealth management industry for traditional users, but now even that is shifting. So that barrier has moved away, and now everybody's open to adopt technology. And, the value is and potential is tremendous.
Absolutely. I mean, Lou, if I can ask you a question, as providers, we're a product provider. We've obviously embraced digital in some of the technology and products that we bring to market as Innate. But really, what are you seeing play out in advisor practices around the world? And what are the biggest hurdles around digitization in terms of how they can add real value to their practices?
Well, when we did our study of 500 wealth and asset management providers, we created a digital maturity framework to look just how far advanced were providers going to meet the digital needs of their investors, as Tej pointed out. Okay, so we looked at about 10 different areas of digitalization, which is important to keep in mind. So one was interactive customer experience, which is what Tej was talking about, the Netflix effect, right? And hyper personalization of customer experience through technology and through bionic advisors, advisors that have technology at their fingertips. We also looked at other things, having automated processes to make it frictionless, that intersection. The use of emerging technologies, AI, blockchain, more advanced forms of cloud, hybrid cloud, because that's important to be able to innovate quickly and to find more meaning in data. And data and analytics, of course, is very important. And advanced cybersecurity, extremely important in today's world. And now what we just heard, where geopolitical issues are going to merge with cyber warfare, I mean, the banks are sitting ducks if they don't have cybersecurity. So it goes on and on. There's even employee experience and advisor experience, which needs to be as automated and digitized as possible. So we looked at all of those things. And what's interesting is that a lot of institutions in the wealth and asset management are at midstream, going very fast in becoming digitally transformed, very fast. And even some of the private banks and institutions that, I once had a call with Rothschild. Evelyn Rothschild was a part owner of The Economist magazine. And he said, if our client needs a computer, they shouldn't be our client. I mean, really an old way of thinking. That's so old now, all right? So we're talking about, as a matter of fact, things have changed so much in our study that according to our digital maturity curve, many incumbents are ahead of fintechs in digital transformation, if you can believe that. And it's because when you think about true digital transformation, you're thinking about tying it into compliance, tying it into employee experience, cybersecurity, things that sometimes incumbents actually do better than fintechs. So it's actually starting to move. I'm starting to see, and of course, your point that lots of big companies, financial institutions, have already acquired and partnered with fintechs. So they've already adopted some of this. So it's moving fast, is what I'm saying. So what's stopping it is, Mickey, what you asked. So, okay, the big one, there's a few big issues. that people worry about. One is the one I mentioned, cybersecurity, because the more you move digital, the more you could expose your company to digital risk if you don't do it correctly. And that's a very big concern for organizations, and a bigger concern, I'm sure, this week. Okay, because, and I've talked to a lot of people, they say, we don't want to be the bank that, you know, has this big breach, because our business is based just on trust and we cannot afford to lose it. So that's one big thing that can slow them down. The other that I think is the legacy systems. These are some of these are monolithic organizations that have very complex legacy systems, as you know, Mickey. And I mean, and one of my clients said, it's just spaghetti all over the legacy system. And we built it as we went along, and, you know, it doesn't completely hang together. And it's a challenge because you really have to move to a modern IT infrastructure, typically cloud-based, very often open market, so you could do automatic APIs and all the things that Tej was talking about that Netflix and Amazon does. And that requires a very big retooling. And that's hard to do for a lot of these bigger organizations. It's easier for a fintech to start from scratch. And then the other thing that held a lot of people back was the business case, because it's not just digital. Digital is not just about cost savings. That's the old-fashioned way of thinking digital. You got to think about it the Amazon way. It's a way to drive your top line. It's the way to energize your folks and get greater productivity and more revenue. And so a lot of people don't fully get it. They understand cost savings, but it's hard to make the conceptual leap to revenue gains. But our study hopefully dispelled some of those problems with business case, because what we found, I'm going to just tell you, productivity for those people that are most advanced in digital maturity, their productivity went up 13%. Their AUM went up 8.1%. Their revenue went up 7.7%. Their market share went up 7.3%. And their shareholder value went up 5.8%. So, I mean, we're talking about a very strong business case to do this, beyond just that your client wants it.
Sure. Thanks, Lou. I mean, Gizelle, just listening to Lou, you know, there's always this comment, and I think Lou said that's not the case, but there's always been this comment that tech is for the young. You know, and it's not for the old. Lewis said this, but, you know, it's the wealthy, probably the older generations, and that have the best smartphones, the best access to technology. How are you seeing tech, I suppose, and the embrace of this technology in the context of the South African client, and across the board, really, in SA? You know, are we there with the rest of the world, or are we sort of lagging behind?
We are there. And I mean, let's just categorically say it's not only the young that are using tech. I mean, everybody's using tech. It's just the degree to which they're using it that might differ from person to person. And I think, I mean, perhaps if I just think about it from an advisor perspective, I mean, the way I sort of think about this incorporation of technology and practices is about sort of think about it on a spectrum, where you've got the one side that's sort of 100% digital, automated, almost like your robo-advisor sitting over here. And on the other end of the spectrum, you've got like 100% face-to-face human interaction, all that kind of stuff. And all of your clients sit somewhere on the spectrum, right? They all fall somewhere over there. They're all going to need a little bit of both. It's just the degree of how much they need of each end of that is going to perhaps differ. So you need to sort of almost have this like hybrid model in your practice where you can service both the technology needs and the human interaction needs. As long as, a very important but, that no matter where you are on the spectrum, it's got to be incredibly, I think, as Lou mentioned, customer-centric. It has to be. None of it's got to be generic. It's got to be customer-centric, so the client actually feels that there's value coming out of that relationship.
Louis, a question for you, and listening to the guys now, you know, Lou just spoke about, I suppose, providers coming out with new technology, cloud-based, etc. You're a financial advisor, you're working with existing providers in the market. Let's say, for example, they're still heavily paper-based, you know, and so you're embracing technology in your practice, but the providers that you use are still heavily paper-based. And so it's, you know, sitting down at a desk, filling in a form, emailing it somewhere, or dare I say it, even faxing. I've heard that there are still some providers that accept faxes. I didn't know that facsimiles still exist. My kids will probably ask me, what is that machine, if they ever saw one. But I mean, we know that a lot of the providers are, what I believe at least, late to the game to come and re-platform. Our business, I think we've invested heavily in technology over the last 5 years, and we're seeing some of the other South African providers only starting now really to invest in technology and approach this concept of re-platforming. How do you approach that as a financial advisor? What do you think about when you're working with providers that are or aren't bringing you new technology to make your practice easier, more simpler? And what are some of the things that, as a financial advisor, you are looking for from these providers from a technology perspective?
That's a great question, Mickey. And I was laughing there, but because I think that a lot of the providers just end up losing business. If you expect us to send a physical form that we have to scan, that's not going to happen because we've been paperless for the last 3 years. There is, we're working 100% remotely. So there's no way that I'm going to get a physical form to you. And so the changing engagement with our clients is the way that we reflect that back on the providers. We're saying, how do we get our data in front of the client? How do we make them the owners of the information so that they can move it around different product providers? I think that's part of the independent piece where, the provider that's going to make our lives the easiest and then, in turn, make us look better. Because we don't really, as financial planners, we don't really have a very strong and big brand. There's quite a few brands in South Africa that clients resonate with and that they feel safe. And it goes back to my first, comment around, do clients have the ability to look at how technical or the technical quality of our advice? It's really difficult for them to look at that and actually say, hey, is this advisor adding value or not? But what they do know is the communication, the trust, what happens when things go wrong. So I think if you look at our framework, when we decide on partnering with a product provider, it's always about what happens when things don't work out. Does the product provider come to the party to say, hey, we messed up, we're going to put the client in the same position, we're going to make them whole? So that's probably the number one component. And then saying, well, how easy is it to do business? What supporting elements do you have to help us train our staff to engage? How pleasant is it for someone to phone into your call center? Do they speak to a robot? Do they speak to someone that's going to help them the first try? So I would say that it's really about that company's culture. And is it a match between the financial advisor and the way they want to run their practice? And probably it's putting on your business owner hat, saying, is this going to be a good merger or a good marriage? If not, we're fortunate that there's many product providers in South Africa. You're not forced to deal with one. And so those are the things that are really important. And then I think technology sits on top of that. It's almost become a given. There has to be a certain measure of straight through processing, efficiencies, almost a zero tolerance for administration mistakes. But the question then is, when that happens, what is the response from the provider?
It sounds to me like, Louis, if you're partnering with a provider and your provider is an old school financial services provider, it's probably the wrong one. If your product provider doesn't look more and more like an IT shop, they're probably being left behind. And so, I think all of us are becoming, we're all in the financial services game, but all of us are becoming IT shops, so to speak, in terms of the operational capability that we bring to the market and that we use. Maybe, we're sort of approaching the end here, and we're starting, we've had a little bit of a discussion about the value of technology, how this can translate, I think, into a real PE value in a financial advisor's practice. If you're able to use this, if you're able to muscle up, I think technology is very important. It can no longer be side a desk and really needs to be central to the business. And we've clearly seen that, regardless of age, people are embracing technology. But I thought before I'd wrap up, I'd like to get to a couple of questions, and I've got a couple of questions here. If you just excuse me as I look down. The first one, Lou, I think this one is for you. It seems like you were a little bit controversial earlier on, so they've asked if you could be a little bit more controversial. Some of the common misconceptions around the investor market that you guys see and have heard of. Any insights into that?
Yeah, I do have a few things I would say there. We heard, I think it was Tej who talked about how to do holistic advice and democratize your offering. There are big organizations that we know that offer lots of different financial and non-investment services that they can bring together. And for smaller organizations, they need to partner to get that. And okay. Now, there's a lot of clients that have come to us and said, we think we're going to be making a lot of money by getting people to consolidate their wealth with our institution. And so we asked investors, the 2,300, how they go, and all levels, including the wealthy ones, are they really thinking about consolidating? And actually, they have the opposite opinion. They're thinking about adding accounts and diversifying. Now, they may be wrong in thinking that they need to diversify because of risk, but in any case, they're not thinking about putting more in one institution necessarily. They're thinking about adding institutions. And in fact, there's this idea that people might even change and switch accounts. They switched. About 20% said they switched during the pandemic. When I say switch, they took a large amount of money and put it into another institution. And according to our statistics, in the future, that might change even more and go up to like 30, 40%. So I think what the lesson there is that people, you need to be hyper-personalized. You need to give people what they want, and they want more holistic services, and they want more innovation, and they want a really seamless digital experience and many other things. If they don't get it, they're willing to be swayed by others. Okay, I think that's one thing to keep in mind. I think it is true that there's a generational wealth transfer. There's no denying that, and that's going to take 10 years, as we heard. But it doesn't mean that boomers are not a really good market because of the other trend that we talked about, which is longevity. So people are living longer, they're working longer. I'm still working. I'm 70 years old. I'm not going to retire soon, and I'm making more money now than I made 10 years ago. So, and I have my own business, so I have even more needs for financial institutions. So frankly, I think you got to be a little bit careful when you say, everything's going to. It turns out that lots of financial institutions are planning to make a lot of money from baby boomers, and there is more focus for the 500 institutions I talked to on baby boomers than there is on the millennial market. So that's another thing to keep in mind. And I think the other thing to keep in mind is that we're in the period of hyper personalization. I think it's hyper competition. And when you think about personalization and you think about what people are trying to achieve, I find it really interesting. There are institutions that are fintechs that I work with, like Stash, eToro, that were more at millennial, mass affluent. They're trying to go up market. Schwab going up market to upper high net worth, moving from their retail bank investment days. Many, for holistic reasons, they're expanding their advisory services. They're expanding their products and services. They're moving into new geographic markets because the digital allows them to do that. They're maximizing cross-selling opportunities. They're using Netflix techniques to learn about how to very fast acquire new customers through using social media. So it is, and then there's others that are going down market. Big Swiss private banks that are saying, I'm going to have a robo, I'm going to have electronic, because I want to bring in people that are maybe lower income. I can serve them with robo cost effectively, and they are going to become the multimillionaires of tomorrow. So I think you've got to be contrarian. You got to challenge yourself. That's why I'm bringing this up, not to be just devil's advocate, but I actually think it's important.
Good. Thanks, Van Loo. I got another question here. Tej, I think you're probably the right guy for this one. What are the different ways wealth managers can differentiate themselves in the market? You know, we've heard a lot here, can be a bit of a crowded space. How do you stand out from the crowd?
Yeah, that's an interesting point. And I think when you think to respond to something like, differentiation, how do you differentiate? At least in the context of wealth management, what comes to my mind is 4 things advisors and wealth management firms can do to differentiate, above and beyond, having technology, having right processes, all those are needed. Absolutely. Those are table stakes. But to truly differentiate, they need to focus on 4 things. Be aware of your customers, be aligned to your customer with respect to, again, this is where you talk about, being aware of their preferences, their behaviors, understanding their philosophy, understanding their needs, and so on and so forth. The third thing I would talk about is be aware that how can you be relevant, more and more relevant. And this again goes back to holistic advice. This goes back to, how do you provide engagement for life? So be relevant. As long as you're relevant, they would keep engaging with you. And that engagement and relationship would evolve into a, next stage of sophistication. And then finally, the 4th thing is, be proactive. You cannot know things as an advisor, but do not outreach. You need to, it again goes back to, the Amazons and Google examples I took, where know before they know. And don't stop there. Know before they know, and then communicate with them, interact with them in telling them that this is what you might need. Have you considered doing this? Amazon is not pushing that product to us. They say that, we have observed that people bought this, also buys this along with it. So they are actually nudging. And this is what you could do, being proactive in your communication, in your interactions. So those are the 4 things: be aware, be aligned, be relevant, and be proactive.
Thanks, Tej. Louis, I've got one for you. This is the one that always comes up, I think, to a financial advisor. Immigration has been an increasing trend in the past few years. The chances of beneficiaries spread across the globe has therefore increased. From a transfer of wealth, as well as from a holistic planning point of view, how do you, as a South African advisor, ensure that you're equipped to keep servicing the needs of the next generation?
Yeah, it's a great question. And it's something we ponder on quite a bit inside the business, specifically with elderly clients where their children might be living abroad. And so the question really is, how do you add value where someone is in a country where you might not be licensed to give advice? And so that prompts us to start saying, is these kind of coaching conversations, life planning, life transitions, do we really need to be licensed to give advice in that specific jurisdiction? Or can we partner with someone that might be a tax expert on, US taxes? So more and more we're seeing our clients stay with us because they need their kind of hand-holding process through moving to a different country. But at some point we need to engage experts in that area. And with digital, meetings, it becomes possible. Most of our biggest clients, they don't sit in South Africa anymore, yet we can still look after their assets. We can still have financial planning conversations. And actually, we have to start saying, where do we add the most value? And why is this client still willing to pay us? My question is always, if the Financial Services Board cancels your license tomorrow, how will you still have a profitable business? Will people still be able to give you money if you can't implement financial products? And it's more a theoretical question. I hope no one in the audience will get their license revoked. But it's an exercise that prompts you to start saying, where do you add the most value, and are you spending time working on those skills so that a few years from now you are still relevant?
I think that, by the way, I just want to say to that, Louis, that is where digital can hurt or help also, because what I'm hearing is that as you try to digitally replicate some of these investment decisions and processes, you come across regulations, particularly when it's international. So that's where, you know, humans have an advantage over machines, really. It's for one, and where they differentiate. However, having said that, the more you can incorporate regulatory compliance into your systems, the better it's going to be for the advisors and their clients. And sophisticated companies are doing a lot of that kind of digital compliance, which I think is an exciting new development.
Thanks, Lou. I mean, Louis, you know, I suppose the question then is, are clients, you know, as a financial advisor, do you believe clients are willing to pay for this premium bespoke service? Or is it really going to be a case in the future, if you can use technology, where the cheapest commodity and the best provider of that tech wins? I mean, do you think clients are going to pay up for this?
I think clients are willing to pay where they get value. So the question is always, does the value exceed the price they're paying? Where they're not getting value is in commoditization of financial products. And I think, unfortunately, there it's a race to the bottom, and you don't necessarily want to win, because it means that you're going to be out of business. And so thinking about, you know, where is it that you add value, and does the value that you add exceed the price that they're paying? Otherwise, you know, I think historically what we've seen is that the value hasn't exceeded the price, but maybe the price was so hidden the clients never knew that they were paying, or someone else were picking up the bill. But now with transparency, clients are saying, hold on, this is what I'm paying, what I'm actually getting. And it goes back to, you know, what can you control and what can you spend time on, so that people are willing to give you money for the value that you add. And as long as that exceeds the price, I think there will be a market.
And if I can add to it, Mickey, to what, you know, yeah. So I think value, absolutely, totally agree with it. And then what, if you break it down a little further to value, there are, you know, roughly 3 different types of values advisors and wealth managers could bring to their customers. One is obvious, you know, what am I getting back with respect to return? Alpha. Alpha is on everyone's mind, right? But it is not the only thing. The second and third items are also important. So the second one, if you look at it, it's all about trust. Am I trustworthy as a wealth manager or advisor? Do investors or my customers see, or they trust me with whatever I'm doing right now? So that is equally important. And number 3 is value with respect to my philosophy, and value with respect to, you know, bringing me what I also believe in. So my beliefs. So this is alpha. Getting alpha is one thing, but believing and then allowing me to, at least, you know, enabling me to deliver those are also equally important. So I just thought of, you know, adding, you know, that.
Yeah, and I would like to add something else to it. Basically, I think what Louis was saying is that there's a commoditization of products, and pricing is as a result going down. And we saw that. In America, Robinhood was giving, you know, very free transactions for stock trades, and, you know, it's changing the business model for a lot of organizations, and that's going to continue. So the question is, how do you offset those pricing pressures, and where do you make money in the future? Because you're not going to make it off of stock trading as much as you did in the past. So what we're finding is that organizations, first of all, the good news is that people are still willing to pay for advice, and not just baby boomers. Even millennials and others are thinking that they, you know, if they can get personal service in certain areas, they would pay for advice. The other thing that we're finding is that institutions are diversifying their revenue bases. They're going, you know, they're offering more products, more advice. That's one thing. That democratization can be a trend for growing your top line. But also they're doing things, management fees, performance fees, transaction fees, product fees, net interest income, custodial fees. They're actually expanding it, and I'm seeing shifts in where they make their revenue. And that's what you have to be thinking about. You have to be thinking about, you know, we're in this new world. We're going to be more competition. Prices are under pressure. Where are we going to find our growth? How can we use digital to achieve that growth? And how do we have to change, our positioning, our products, our services, and even, our fundamental business model, how we make money?
Thanks, Lou. Gizelle, maybe a question here for you, I see, which has come through. Behavioral bias. Which behavioral biases do you think clients are most susceptible to at the moment? And what should we as advisors do to be aware of this? And what can we do about it?
Biases, I often get asked this one. Well, I think right now everybody's acutely aware of what's happening in Ukraine. And, we can look past the humanitarian impact of that, but there's also been a financial impact on that, with significant losses seen and experienced. So I'm going to go with recency bias, which is where sort of recent news and experiences influence our decisions. And what's potentially going to happen with this is that, the market might be pricing this in. But for us, we still feel it, and we're still fearful of those losses that we've had. We're uncertain if more losses are going to come. So what you might potentially be seeing from clients is you might be seeing them want to sell, to reduce their global exposure, to de-risk in some way. I'm not a financial advisor, so I can't give you financial advice, but what I can tell you what the research says. And the research says that selling out of the market in these times is generally a bad idea. So as an advisor, it's really your job to try and mitigate this fear in your clients as much as possible, which will be different for different clients and how you manage it. But I think the awareness of it, and I think the words come up more than once in the discussion, the ability to preempt that fear is already a fantastic start.
Good. Thanks, Gizelle, and thanks to all the panelists. I sure for one have learned a great deal from today's discussion. I can definitely see that holistic advice is a trend and not a fad, and that client expectations are changing rapidly. And as advisors, as advice firms, we need to be able to keep up with this. We can't ignore it anymore. Technology, I think that goes without saying. We're all technology companies, hopefully one day in the future. As I've said, we all should be IT companies. And I think the real trick for providers is that, you don't want to use technology to just digitize old paper processes. You really want to change the game from that perspective. And, I do think businesses like ours, like Innate, have done that. In terms of some of the content that you've seen here today, our team will share some of the white papers that we've been discussing. And I think we've really only scratched the surface. There's some really, really interesting information in those white papers. And the guys do go into quite in depth in that. In the coming months, we'll also be exploring some of these trends in a more greater and more practical way, starting with what's in your tech stack, unpacking some of those technologies that advisors should be looking at and how they can directly impact your bottom line. And so I hope you've really enjoyed today. I hope the session wasn't too long-winded, and that you've got some really insightful information. And I hope to see you all soon at one of our Innate dinners. Thanks so much for joining us.
Innate is a registered trademark of Stanlib Wealth Management Pty Limited, an authorized financial services provider.